Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Verizon Communications Inc. Annual Report. Verizon Communications Inc. offers a wide range of products and services to consumers, businesses, and governmental entities worldwide. The company operates through two main segments, the consumer group and the business group. The consumer segment provides various services, including wireless services under the Verizon and TracFone brands, fixed wireless access broadband, and related equipment and devices such as smartphones and smartwatches. Additionally, this segment offers wireline services in specific regions of the United States through its fiber optic network and copper-based network. In contrast, the business segment provides a broader range of services, including wireless and wireline communications, advanced communication services, corporate networking, security and managed network services, local and long-distance voice services, and network access services. This segment also delivers various IoT services and products to businesses, government customers, and wireless and wireline carriers in the United States and internationally. Overall, Verizon Communications Inc.'s product offerings span across multiple categories, including wireless services, broadband, equipment and devices, wireline services, advanced communication services, corporate networking, security and managed network services, local and long-distance voice services, and IoT services. Verizon Communications Inc.'s stock price has experienced a notable surge of over 22.68% in the past year, driven by several key events and factors. The company's strong fourth quarter 2025 results and optimistic outlook for 2026 were major contributors to this increase. One significant factor was Verizon's impressive earnings reports throughout 2025. In July 2025, the company reported better-than-expected second quarter results, with solid revenue growth and increased full-year guidance across key metrics. This announcement led to a 4.14% rise in per-market trading shares. The third quarter also saw strong performance, with industry-leading wireless service revenues and robust broadband growth. However, it was the fourth quarter earnings report that truly propelled Verizon's stock price forward. The company exceeded Wall Street expectations for its fourth quarter 2025 earnings per share, EPS, and revenue, and provided an optimistic outlook for 2026. This included projections of sharp increases in customer additions, mobility and broadband service revenue growth, and higher free cash flow targets. The strategic turnaround and fiber expansion also played a crucial role in Verizon's stock price increase. The company's focus on convergence between mobile and high-speed internet, as well as the near completion of its C-band deployment, contributed to investor confidence. The acquisition of Frontier expanded Verizon's fiber footprint to over 30 million homes and businesses, further solidifying its position in the market. Overall, a combination of strong earnings reports, optimistic projections for 2026, and strategic initiatives have fueled significant investor interest in Verizon Communications Inc., driving its stock price up by over 22.68% in the past year. Verizon Communications Inc., market capitalization of $206 billion, is significantly larger than the average industry peer of roughly $6 billion. This shows that Verizon Communications Inc. holds a significant advantage in their industry. Verizon Communications Inc. trades at a lower price-to-earnings ratio of 12 times and a higher price-to-book ratio of 1.97 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 5.8%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. Industry revenue and earnings before interest, taxes, depreciation, and amortization, EBITDA, margin play a significant role in determining revenue growth or decline. Projections of financial performance of the reporting unit also contribute to assessing revenue growth or decline. Recent merger and acquisition activity in the industry can impact revenue growth or decline, as well as changes in interest rates and discount rates. Macroeconomic conditions, such as inflation, recession, or economic growth, can influence revenue growth or decline. Additionally, specific drivers of revenue growth include sales of wireless devices at subsidized prices, billing credits for device payment plans, variable consideration from returns and credits, performance-based credits or incentives for business customers, and subscription contracts for telematic services. Wireless service revenue growth is a significant driver of revenue growth, while FIO's revenue decline is a notable trend in revenue growth or decline. Enterprise and public sector revenue growth contributes to overall revenue growth, as does business markets and other revenue growth. Overall, the primary drivers of revenue growth or decline are influenced by a combination of industry trends, financial performance projections, recent merger and acquisition activity, changes in interest rates and discount rates, and macroeconomic conditions. Net income and profit margins changes. A summary: the net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by $341 million from 2024 to 2025 due to various factors such as reduced demand for services, increased costs associated with implementing new technologies, and adverse economic conditions. However, this decrease was offset by an increase in segment operating income, resulting in a net gain of $279 million. Despite the initial decrease, the overall trend showed a decline in net income from 2023 to 2025, amounting to $5,513 million. This downward trend can be attributed to increased costs for pension benefits and active and retiree healthcare benefits, as well as higher expenses related to regulatory changes, potential tax liabilities, and ongoing litigation. Profit margins also experienced fluctuations during this period. While the consolidated operating income as a percentage of consolidated operating revenues decreased from 17.1% to 16.3%, segment operating income margin increased from 7% to 8.7%. However, segment EBITDA margin showed mixed results, decreasing from 41.8% to 41% in one instance, and increasing from 21.6% to 22.9% in another. The reasons behind these changes are multifaceted and include increased costs for regulatory compliance, potential tax liabilities, and ongoing litigation. Additionally, the company faced challenges related to industry revenue and subscriber growth, as well as recent merger and acquisition activity. These factors collectively contributed to the decline in net income and profit margins during this period. The company's operating cash flow has been a mixed bag over the years. On one hand, there are instances where it has generated significant positive cash flows, such as in 2025 with $37,137 million, and in 2024 with $36,912 million. Additionally, other sources confirm that the company is indeed generating positive operating cash flow, citing increases in contract liabilities and decreases in contract assets. However, there are also instances where the company has experienced negative operating cash flows. For example, in some years, the net change in financing activities has been substantial, such as a -$17.1 billion used in financing activities. Furthermore, the company's operating and finance leases have contributed to negative operating cash flow. In conclusion, while there are periods of positive operating cash flow, the overall picture is not entirely rosy. The presence of both positive and negative operating cash flows suggests that the company's financial health is not consistently strong. The recent financial summary reveals a mixed performance across different segments and regions of Verizon's operations. On the positive side, the consumer segment stood out with a notable revenue increase of $106.8 billion, representing a 3.8% growth. This segment's success can be attributed to its strong wireless retail connections, which reached 116 million, and broadband connections, totaling approximately 11 million. In contrast, the business segment experienced a decline in revenues, amounting to $29.1 billion, with a decrease of 1.6%. The Verizon Business Group saw a drop in wireless retail postpaid connections and total broadband connections, indicating a sluggish performance in this segment. Unfortunately, there is no clear indication of regional performance in the report, making it difficult to assess how different regions contributed to these results. Management is emphasizing a short-term focus on executing business fundamentals, such as enhancing networks and growing the customer base. However, they are also looking ahead to long-term goals, including adapting to future technological changes and transforming networks through innovation. In terms of strategy, management plans to focus on strategic growth areas, particularly mobility and broadband, while rationalizing product portfolios and implementing operational efficiencies. To achieve these goals, significant capital investments will be made in acquiring wireless spectrum, upgrading networks, and developing advanced information technology systems. Management is also committed to cost management, aiming to reduce costs by pursuing greater efficiency and aligning investments with business priorities. This includes a plan to reduce the workforce by 13,000 positions. Additionally, they are concerned about regulatory risks that could affect business prospects or results of operations, but remain committed to complying with applicable laws and regulations. Overall, management's outlook is focused on executing short-term goals while positioning the company for long-term success through strategic investments and cost management initiatives. Acquisitions made by the company has made several significant acquisitions to expand its services and footprint. One notable acquisition was Frontier, which expanded the company's fiber broadband footprint to 31 U.S. states and Washington, D.C. in January 2026. The company also acquired wireless licenses for $428 million in 2025 and $616 million in 2024, as well as C-band wireless spectrum for $269 million in 2024. In addition to these acquisitions, the company purchased cell towers from Vertical Bridge for $830 million, with payments totaling $431 million. The company also made significant transactions, including a spectrum license deal worth $7.5 billion in February 2021 and the acquisition of United States Cellular Corporation, U-Cellular, for $1 billion. The company's largest acquisition was Frontier Communications Parent, Inc., which cost $22.3 billion, with $9.4 billion paid in cash and $12.9 billion in assumed debt. The company also acquired Starry in January 2026, although the amount of this transaction is insignificant. Divestitures made by the company has made a few divestitures to dispose of certain assets and businesses. One notable example was the cell towers transaction with Vertical Bridge, where the company received $830 million in proceeds and paid $431 million in payments. The company also stated that it may occasionally divest assets and businesses, but no specific details were mentioned. Overall, the company's acquisitions have been significant, expanding its services and footprint through various deals. In contrast, the company's divestitures have been limited to a few transactions, with more emphasis on acquiring new assets and businesses. The company's financial activities have been marked by significant dividend payments. According to the extracted summaries, the company has indeed paid dividends, with a total payout of $11.5 billion, as mentioned on page 37. Furthermore, it is noted that the quarterly dividend payment was increased, and the company paid out $11.2 billion in dividends during 2024, as stated on page 39. In addition to dividend payments, the company has also authorized a share buyback program worth up to $25 billion, which was initiated on January 30, 2026. However, it is unclear from the provided text whether any actual purchases were made under this program. Concerns about inventory buildup and supply chain disruption are valid given the current trade tensions. Tariffs imposed on imported goods from various countries have created uncertainty in trade relationships, potentially leading to supply chain disruptions. The escalation of trade tensions has resulted in reciprocal or retaliatory tariffs, further exacerbating the situation. This prolonged uncertainty can cause suppliers to fail in providing equipment or services on a timely basis due to global supply chain disruptions caused by geopolitical factors and other external events such as public health crises, natural disasters, and extreme weather conditions. The changes in tariffs and trade restrictions have also contributed to the potential for supply chain disruptions. As a result, businesses must be prepared to adapt to these changing circumstances to mitigate the risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for Verizon Communications Inc. Feel free to comment below, and I will be happy to answer them when possible.